Hello and welcome to this webinar titled Price Action Drives Trading Plans. You should be seeing my PowerPoint presentation now in front of you. My name is J Kahn. My consulting company is JupiterPeakFinancial.com, so that's a website where you can find a lot of information about what I do and lots of commentary and education that I provide. If you have any questions, you're definitely welcome to email me there. And if you have any questions throughout this webinar, please take advantage of this HotCom software that FX Street is providing us today. So again, a special thank you to FX Street for having me on, and I would like to go ahead and start the presentation. But again, I will be answering questions back and forth. We're going to be jumping from PowerPoint presentation to different charts and things like that. So as I do that, I'll be pausing to make sure that I'm answering your questions. So just making sure that the audio is okay, because I'm getting a little bit of mixed messages here. So half the people seem to be saying audio is okay, some not. So just doing another audio check to make sure that you can hear me. Okay, sounds like audio is fine. All right, we're going to just move to the next slide then. So just a quick disclaimer. As we're going through this, again, this is for educational purposes only. Obviously, you know that you're trading leveraged products when you're entering the Forex market, and so you do not want to be trading with any risk that you think that you need anytime soon. So it's basically capital that you're willing to lose. Obviously, with well thought out trading plans and things like that, that's not the goal, but anything can happen at any time. And if we're trading without discipline, even if we're trading with the best laid out plans, things can happen. So I'll just leave this up for just a few seconds for you to review this. And again, I'm going to be moving from brokerage to brokerage so that you can see different charts, and I don't want those to be any recommendations. You have to do your due diligence, which broker is right for you in your own trading situation. So just a little bit about me, very, very briefly. Some of you were with me in the monthly webinar that I did for FX Street last month, and so I'll give you that link in just a moment because some of this carries over, but I think it's important for setting the tone. The first line I have up there is ski bum. And that's why I put that up, is because that's what I wanted to be. And I actually just met a trader while I was being a very good ski bum. And so I learned to do it. And I kind of break the ice out there by saying, if I can do it, someone who wanted to be a ski bum, then anybody can do it. So when I met this person who wanted me to trade for them and they didn't want me to be a ski bum anymore, I was happy to learn from them because they were quite successful, and they taught me about being a scalper. Very, very short-term trading using market flows. As the markets changed, as technology changed, as my location changed when I moved away from the market center, I adapted to various market strategies and timeframes. That allowed me to understand different people out there and their various goals and their different risk tolerances and their different account sizes. So I founded Jupiter Peak Financial, which is a consulting company teaching people to trade and invest, manage their risk in their equity portfolios and retirement portfolios and things like that using various market relationships. So my approach to trading is I take a big fundamental view. I look at long-term, I look at short-term, I look at inflation and economic policy, stuff that's very important and very prominent in our trading and investing right now. Obviously, no time, I don't remember a time like this where there's been such a big area where we have central bank intervention and government intervention, and that's affecting the markets, and that's what we're going to talk a little bit about today. So I think that I approach it from the large macro view, and then I start to go down and really hone in on that individual and what they're trying to achieve given their individual specific situation. So my trading strategies, I made up the word swalping. It's kind of a combination between scalp and swing. So I'm a pretty short-term trader in Forex, looking for 10, 15, 20 pips. That's what I consider kind of a scalp short-term trader in the foreign currency markets. Depending on volatility, that trade might turn into a little bit longer. So if the volatility is big and the trading ranges are large, I might move out to risking 20 or 30 pips to make 40 or 50 pips. It all depends on what volatility is telling me, and I'm going to show you that today. I also use Forex to hedge intermarket relationships. So if I have a large position in gold or if I have a large position in equities, and I think there's a relationship between equities being overbought and rolling over, and that carrying over into a Forex pair relationship, maybe between the United States dollar and the Canadian dollar, then I use those to hedge. So I look at short-term opportunities and long-term opportunities in Forex. Again, I consult with people who don't trade Forex out there, so I also am very savvy with understanding sectors in the equity markets, indices, and specific stocks, and how to create option strategies around those markets for growth strategies, income strategies, portfolio protection strategies. And that disclaimer there is very important. Understand each strategy very, very well and what it's meant to do for your portfolio and the risks of each strategy. There are no free lunches out there, so it takes time to be able to move from market to market to market and do different strategies in different time frames. But that's what comes with 15 years of doing this every single day. Why do I teach? A lot of people ask me this. It's a win-win. I'm a social person. It can get lonely sitting in the trading room in my office by myself. I like talking to other people. I used to be on a floor in Chicago. I'm not there anymore because of technology allows us to do it from wherever we want to be. So I just like to be in touch with other people and talking to other people and having trading clubs to go to and teaching other people. It kind of holds me more accountable. It holds me accountable to an individual, and it also holds me accountable to myself, because if I'm teaching them the rules, I better be doing those rules correctly as well. So I like that accountability. I also am registered. I have a Series 65. I'm going for my Series 3 soon, as I may become a CTA or run a commodity pool. And to do that in the United States, you have to have a Series 3 and a Series 34. But the Series 65 gives me a fiduciary responsibility. It's basically, I'm not managing people's money, but I have the same sense of that feeling of an advisor managing people's money, because when I'm teaching someone and working with someone, I need to know everything about them so that I can try and get them to see the different opportunities out there that their overall situation holds. So a first question came in. So you offset risks in long-term positions with scalping. Is that it? Not really. I scalp to be a scalper, but if I think that I see a long-term relationship between one market and another market, I might take a longer-term view. So I become also a position trader or a longer-term trader in Forex as well. So I'm not just looking at the small moves in Forex. I'm also looking at those daily and those weekly charts, and I'm actually going to show you a longer-term trading opportunity in the Forex markets as well today. Quick outline of where we're going. Trading psychology, the paragraph that described today's webinar, I did mention that I'll talk about trading psychology. I have a hard time believing that trading psychology doesn't fit into every single, day of that a trader, is approaching the markets. So whether I'm teaching a class for a few hours, whether I'm doing a short webinar, whether I'm writing a daily market commentary, trading psychology always comes into it. So we're going to really briefly review trading psychology. I'm going to give you my brief fundamental update, which will lead us into the charts. We'll look at the VIX, the volatility gauge, and then we'll go into technical analysis, looking at the equity markets and the Forex markets and these relationships. Keep in mind where we're going. Today, we're not doing any indicators out there. We're just using 3 words: trend, support, and resistance, and focusing on location, location, location. I keep it super simple, all right? And I think that you guys can really keep it super simple and be very safe traders and have some success in these markets. Most people that I work with that are current traders that come to me, they're trading too much and they're not trading in the right locations. They don't know how to pick the right locations. And so I say, if we can cut out 50 to 80% of your losers, what would that do to your profit and loss? So if it's someone who's brand new, they don't have any bad rules, that's different. If it's someone who's currently trading and has some bad rules, then we basically, again, start from scratch. So that's pretty big, is location, location, location. I don't care how many indicators or whatever you want to use. It goes back to good location, good trade management. We'll talk a little bit about your opportunity. I'll review and then give you some links to those resources that I talked about earlier, such as daily market commentary and things like that. You are the system. I talked about this in the monthly webinar. I do believe that if you understand who you are as a trader, you have a chance to succeed. Many, many, many traders skip this step. They hear about the markets, they fund their account, and they just go trade. They don't understand where they fit into the markets. The markets are this 100 puzzle pieces just thrown out there onto a table. And you are one piece trying to fit into this mess. It's not the other way around. The markets don't fit you. You fit the markets. Do not skip this step. This is a critical step that I do when I work with individuals. I kind of help them nail down who they are as a trader. It's sometimes hard for people to understand that because they get so much education analysis that can be good, but they don't know how to filter it for their individual situation. You have to filter it. You have to fit the markets, not the other way around. So I did a monthly webinar about defining your trading personality for FX Street. So we're just going to pause for a second. I'm going to bring those up because where we're going anyways is into fundamental analysis. So as this next slide says, use the FX Street data, use economic data to help you. I believe that you have to pay attention to fundamental analysis. I mentioned that we have government intervention, central bank intervention, more so than ever before, and it's really, really affecting the markets. We have a ton of data coming out over the next few weeks. The Federal Reserve in the U.S., Ben Bernanke's talking in Jackson Hole. We have European leaders meeting. We have lots of economic data coming out. We have elections in the U.S. coming out in about 10 more weeks. Lots and lots of data. I think that this fall trading session, September, October, November, December, as kids come back to school, as traders come back online, I think it's going to be a very busy, fun time. So we're going to move into the charts now. But before I do that, again, I just want to go ahead and give you this link to this webinar that I did that talks about your trading personality, defining your trading personality, okay? And then we'll jump into fundamental analysis, and then we'll quickly jump into the charts. So questions, this is a good time for questions as I move from application to application. Okay, so right here in front of you should be popping up is the FX Street website. A great amount of fundamental information is on here, and analysis and news. So what you're looking at is my profile. So if you just search for Brian Kahn on FX Street, you'll get today's webinar link, obviously. That should be recorded and downloaded soon to the site if you want to review it. But also I've done a monthly webinar, part 1 and part 2, about your trading personality, which I think you should review. And I've also done one about volatility to build realistic trading plans. So you can see that I use the word realistic a lot because, again, a lot of people aren't realistic. And right now, where we're going into the technical analysis, you're going to see that you're going to need to be realistic because these markets are hard, really, really hard to trade if you're not being realistic. And they're screaming at us. The markets are telling us always a story, what to do. And they're telling me to trade a certain way right now. And there's a certain tool that I'm going to teach you that tells me how to trade that way. All right, another strong tool, remember I said a lot of economic data coming out, so the economic calendar. Please stay on top of this no matter what time frame you're trading, no matter what pair you're trading, no matter how often you trade in the day, there's economic news coming out. You have to be aware of it because, one, it sets the tone a lot of the times, and if it doesn't, it has the possibility to at any time, so you don't want to get caught, obviously, like a deer in headlights. You don't want to be surprised by anything, so keep that in mind. So use the FX Street website for great analysis, great contributors, and a great amount of data that can keep you informed as a trader, okay? So someone mentioned in the coming months, volatility is what scalpers love. So we hope that there's more volatility. So Mike, thank you for mentioning that. That's where we're going right now. So again, I'm going to change applications. Just bear with me. And we're going to move into a platform. Remember, none of these platforms are recommendations to go with that broker. It's just ones that I'm comfortable with. All right, excellent. So you should be looking at a platform here. And again, this is TradeStation. Everybody can see that. And so we're looking at some charts here. And the first chart that I'm going to blow up here is the VIX. Forex traders, a lot of us don't pay attention to VIX. It's a volatility gauge, and it has to do more with options. But the VIX is a volatility gauge, and it's telling us how much movement is out there. And as you can see from this very long-term chart, the VIX is very, very, very low. It's down around 14 and 13 and 12. And if I match these up to be on the same time frame, you'll be able to see the chart below it, which is the S&P, which is the broad index. So just bear with me. I'm going to change this time frame back to a daily. So long term, we're very, very low in the VIX, the volatility gauge. Look at the difference between these two charts. They're exact opposites. So when the S&P goes up and up and up and up and up, the volatility gauge goes down and down and down and down. So as equities are going up, no matter what's going on in Europe, no matter what's going on around the world, Volatility is shrinking because equities are just saying everything's fine. Why is everything fine? Because of central bank intervention, because a Jackson Hole symposium maybe this week, and Ben Bernanke might give us more quantitative easing, because the central bank might do more bailouts over in Europe and the Bundesbank in Germany and things like that. So more so than ever, we've got to pay attention to political events and government events and central bank events. But what it's doing is right now, currently, it's driving volatility to the floor. That's driving trading ranges to the floor. So I'm not going to spend more time on this relationship because I think you guys get it, but I'm going to prove to you how low trading ranges are right now and how that, for me, helps me make a trading plan. I'm not saying there's no trading going on. I'm just saying it helps me with realistic trading plans. All right? So let me just get back over here. Bear with me. Okay. So we're just going to jump back into, I'm just going to check for some questions. We're going to jump back into the PowerPoint presentation here. So we're moving from fundamental analysis, where I mentioned look at the VIX so it can help you with realistic trading plans. Now we're moving into technical analysis. One, the trend, the old adage, the trend, it is your friend. Keep that in mind, whether you're a short-term trader scalping or a long-term trader, all right? Support and resistance. These three words alone, I believe that you can be a very, very, very safe trader. Just with these three words alone, you can be a safe, successful trader and manage your trades with a well-thought-out trading plan. Along the lines of support and resistance, where we're looking for risk-reward and setting up positive risk-to-reward trading plans, don't play in the middle. Don't get caught in an area where it doesn't line up with good risk-reward. That's what I mentioned. Lots of people overtrade, and they don't understand that overtrading can be a bad thing. And especially right now with the markets with low volatility, overtrading can be deadly. All right. So we're going to build trading plans with reasons for entry, and then technical reasons for stops and technical reasons for targets. It's all based on the charts. Okay. Fundamental opinion, then charts tell us where and when to do things and how to manage. Would you advocate upping leverage in these times of low volatility and doing the opposite in other conditions? So that's what someone says is, would you trade larger now because there's lower trading ranges? So the answer is yes, you can, but be aware that these events and these economic data events that we have to pay attention to can happen at any time. And so you just have to be very vigilant in saying, okay, things are now changing. Tomorrow, boom, we're now in a volatile market. I've got to adapt and change. So you just have to be on your trading psychology game of being able to read the markets and being able to adapt as they adapt. Also, going back to larger size, obviously, I don't want anybody over leveraging their account. So if you have the account size, and let's say that you have a $10,000 account, most traders risk between 1% and 3% of their account. So 3% of a $10,000 account would be about $300. You don't want to be bumping it up. If you're usually trading 1% in volatile markets and now you bump it up to 3%, that might be okay. You're risking $300 or so instead of $100. Things are moving a little bit slower. You're able to manage it and things like that. And you don't have the risk of volatility coming in today and making your $300 loss $500 or $600 or $700 loss. It's going to probably be a $300 loss because you may not have much slippage. There's not going to be much gaps, things like that. But I don't want people going and saying, oh, I usually risk 3% in a volatile market. Now it's not volatile. I'm going to risk 5%, 8%, 10%. That's over leveraging your account. So just keep it in check with your own money management, your own account, and trade risking what you're comfortable. All right. So that's what Fernando was saying. Can you do that to normalize for returns and risk? You can, as long as you're not taking on too much for your individual situation, as long as you don't get emotional because it's now becoming money and not the mechanics in the system. Have you noticed lately, though, that reactions to news are never in line with the fundamentals? Andy, perfect. Economic data in the U.S. stinks. Economic data around the world, you guys, stink, okay? It's really, really, really bad. But what is the equity markets doing? They're going to the moon. What is volatility doing? It's going down. The volatility gauge is telling me, Andy, it's telling me there is no fear out there. There's absolutely no chance of movement. So as an option trader, we need movement, just like in Forex. And if we buy an option, if it doesn't move, options have a decaying time component to them. They have a time component. So not only does it just not move, but it starts to lose. The position didn't even go against me. In Forex, if it goes sideways, your profit and loss is sideways. If you buy an option and it goes sideways, you actually start to lose money. So you have a time component. So you don't want to be too aggressive right now and say, hey, it's great. I want to trade right now, because I don't think that there's as much opportunity. I think there's still opportunity to make money out there and have good trade setups out there. They may just not be as frequent. So hopefully that answers your question, Andy. Do I regularly focus on just a few FX pairs, or you scan many of them each morning for high probability setups? There's about 10,000 stocks out there. I keep a watch list of about 20 to 30 at the most. Maybe when volatility is higher, it's down to 5 or 10 or 15. So volatility drives my watch list. Depending on where you are around the world, obviously Forex is different, because I would love to be living in Europe and trading the European session, because that's been busier than the American session. I'm in the American session. I'm trading that. I don't like to trade in the morning and then go to sleep and trade all night and kind of be all wacky. I've been trading for 15 years. I've never traded overnight before. I've traded German bond futures. I've traded U.S. bonds, traded, like I said, options and commodities and Forex, but I always trade during the U.S. session. So I'm usually using the majors. And let's face it, no matter what, most of the volume is going through at the European close, American open, and most of the volume is in the U.S. majors. So I just have to be complacent as a trader right now and say, look, it's going to be a different time right now. I can't expect to get off that many trades right now. I just have to be patient. But it's not worth it to get all mentally distraught, trade, have a poor track record and be frustrated, and then the markets get volatile and my mindset is not right. I've had to shrink my trading size because I've been wrong so many times, because I've been over trading, whatever it is. So trading psychology comes into this market every single day. Primarily, I'm a U.S. dollar major trader. So the pound, the euro, the Aussie, the New Zealand, the Swissy, and the Canadian against the United States dollar, because also I understand the equity markets and things going on in the U.S., and there's some nice relationships, and we might be able to touch on that as well. Are the majority of your trading options or FX? The majority of my trading is FX as a day trader, sometimes as a hedger, as I mentioned. But right now, there is definitely more volatility in certain sectors in the equity markets than there is in FX. So right now, my FX trading is a little bit less frequent than it usually is. So you might say that I have more stuff going on in options right now, because I also do various strategies. I'm not just long or short the equity markets. I can be neutral. I can have income plays. I can have hedges in place. So when the S&P hit resistance at 1425, that was a place where I said previous resistance from March, April, and May was at 1425. It's coming up to 1425. If I'm hedging and managing a portfolio and trying to reduce that risk, it would make sense to me to buy puts at that time. And as the markets roll off and hit resistance and go down, equities in a long-term portfolio on paper are now worth less, but the bearish trade is worth more. So there is a little bit more volatility right now in the options markets than FX. That flip-flops all the time, but that's just kind of how it's been lately as the equity markets have been moving a little bit more. Some pairs are more volatile than others, but I'm going to show you trading ranges in just a moment. So my option tradings are non-Forex. Do you use options for Forex? No, not really. I usually trade cash or futures in the Forex markets, and then I'm just trading options on the indices or ETFs or individual equities over there. And again, most people I teach, a lot of people have jobs and they're trying to learn trading kind of just in the background. Maybe they have money invested with a portfolio manager and they want to take out a subset of that and they want to learn to do it, and they want to learn covered calls and all different strategies. So a lot of people, you have to remember, Forex day trading, that's day trading. You have to be either retired or you have to have 4, 5, 6 hours in a row sitting there. Most people who are working for a living right now don't have 6 hours after they come home from work. Hey, family, hi, I'm having dinner and I'm going to sit in front of the markets. I'm not going to sleep at all, and then I'm going to go back to work the next day. So I do have clients that are definitely Forex traders, day traders, and use Forex traders to hedge larger accounts. But a lot of my consultants that I work with, a lot of them have investments in the equity markets, and they want to learn some extra strategies there to produce some income on their portfolio, to hedge their portfolio, to buy back in on dips and things like that. Same rules, same trading plans, just a little bit different strategies to do it. We still use fundamental analysis. We still use technical analysis. We still use trading plans that make sense to our individual account. All right. So trade Forex options. No, I don't trade any options on Forex. Like I said, I just stick to the cash or the futures markets themselves, and then use options in the other markets on the equities themselves, ETFs or indices. So technical analysis, we're about to move into the charts. I think that we have one more slide here that I just want to show you. So short-term traders, realistic trading ranges, again, going back to the VIX, using the charts to tell you a story. Your trading time frame, when are you trading, how often are you trading, what are you looking for, what's the volatility? Let's go build a trade. And as we build trades, I'm going to hop back and forth from equities to the Forex markets just to show you some short-term and long-term trades, okay? So good questions, you guys. And like I said, I'm going to go ahead and reduce this manual here that I can't see any of the questions coming through for just a minute, but please keep pumping in your questions and I'll jump back in just a moment. So we're going to jump into, you guys are here for Forex, let's jump into some Forex charts. Okay, you are now looking at Interbank FX. It's a MetaTrader 4 platform. Lots of brokers out there offer this MetaTrader 4 platform. I just want to show you guys, as I was doing some work prepping for this, we understand what the equity markets are doing. They're going up every day pretty much. We understand that the volatility is going down. Look at the volatility in the pound since May, June, July, and August, and we know it's summer markets. Hopefully it gets busier and more volatility, as I think Mike said. We're looking for more volatility. But until just the past few days, we've had a 57.50-ish to 54.60, about 300 pip range for 3 or 4 months, all right? That's pretty tight. In volatile markets, we'd like to see 100, 200, 300 pips in a day. We haven't seen a breakout of 300 pips in a range in 4 or 5 months, okay? So keep that in mind, that that's kind of what we're seeing with lower volatility, all right? There's some sideways action. Not all markets are going sideways, but a lot of us trade the pound versus the U.S. dollar. All right, I'm going to pull up a Australia U.S. dollar. So remember, just before I do that, though, if we're talking about trend, support, and resistance, you guys can see that there's absolutely no trend in this time frame in the pound. You guys can clearly see where support is and resistance is. You can take advantage of that. No indicators, no Fibonacci's, no MACDs, no stochastics, no moving averages, just support and resistance and understanding what's going on in the markets fundamentally and what it's causing technically the markets to do. Nice range bound. Finally, it breaks out. So if you were short up here at resistance, you would have covered, but you would have said, I'm short at resistance because I expect resistance to hold. Resistance does not hold, it breaks out, I have a small loss. I'm not still in this loser short. I'm out of this loser after 30 or 40 or 50 pips. But in the past, every time I risked 30 or 40 or 50 pips, it reversed and made 50 pips, 80 pips, 100 pips, 150 pips. That's risk to reward. Risk 50 to make 100. So for the first time in many trades of support and resistance, it finally broke out. I had a loser, and now that loser teaches me new information. Hey, we're breaking out. Why are we breaking out in the pound? Why is the pound strengthening to U.S. dollar? You start to go through that in your analysis and fundamentals of the pound and that region and that economy versus the U.S. dollar in our region in our economy. Are we going to lower interest rates again first in the U.S. before they go and do it in Great Britain? Something like that. That might be it. So we're going to buy Great British pounds. We're going to buy the pound versus the U.S. dollar because we think it's going to strengthen. All right. Going to a different pair, the Aussie U.S. dollar. This has been a fun one, so I'm going to blow this up so that you can see it. All right, and that's on. This is a weekly chart. This is a weekly chart. So going back for over a year, going back into 2011, you can see support and resistance. Support and resistance. 97.50 at the bottom where we just bounced, and it heads back up towards 108 or so, and we were just getting up to that area. So there's your big support and resistance. Very, very sideways over the past year and a half. Yes, big trends in that range up and down, but very, very sideways in between there. All right. So I'm just going to draw, I said I wasn't going to do it, but I'm just going to draw a trend line because obviously we like to have some technical analysis. But a lot of you probably saw this. I actually wrote about this in my blog. That's a trading opportunity right there. Why is that a trading opportunity? Even without the trend line, this is a big move. 96, 97, 99, $1, so it's a parity, $1.02, $1.03, $1.04, $1.05, $1.06. That's 10 pennies, you guys. That's what? 1,000 pips? That's a pretty big move, and that happened, so I can show you that on a smaller time frame. That 1,000 pip move happened from June of 2012 to August of 2012. So all of June, all of July, and a week in August. What did the stock market do during the same time? Just to save time, the stock market bottomed out in June and has rallied ever since. It went 1300, 1350, 1400, 1425. It went up about 125 points or more. It went up, that's a great amount of percentage in the equity markets. All right, it went up roughly around 12 or 13%, something like that. Then the equity markets hit resistance, and roughly around the same time, you have this starting to hit resistance, okay? So there are some of those relationships there. So even if you didn't have a trend line or anything like that, you can just line up, hey, commodities have gone too far. Hey, I think the stock market has gone too far. It's gone sideways a little bit. Why do I say that? I am going to switch the platforms very quickly, so just bear with me. Please analyze USD and Canadian currently long. Okay, I will definitely do that. We're going to go there because I'm actually going to move into the US Canadian right now. So I want to show you, as I said, some of these intermarket relationships, okay? So down here, we're building trades, intermarket relationships, so SPY and the US dollar, and we'll definitely use the US dollar and the Canadian. Also, obviously, for your long-term traders, when I built these slides, things were a little bit different, so we're not going to use the pound and US dollar for long-term traders and hedgers other than that range that I showed you, but we will use US dollar Canadian. We will also use the Australian dollar and the US dollar. So short-term traders and long-term traders. Also, as I said, long-term traders can be hedgers because there are relationships between commodities going too far in the equity markets, the Aussie dollar going too far in the Forex markets. You go short the Aussie dollar at a premium, and if it rolls down, it might hedge. Maybe if your equity markets that hold some commodities in there, that commodity sector, it might hedge some of that. You can also do that with oil prices and the United States dollar Canadian. So if you're long oil physicals, if you have an oil company where you're buying oil, and you need to use it as a producer or a user, or obviously if you're just invested in that sector or work for a company in that sector. So long-term and short-term opportunities. Let's go back and let's get towards the US dollar and the Canadian dollar. But before I do that, I'm going to just show you an equity chart. Okay, so right now you should be looking at a chart of USO. All right, USO is an equity ETF that tracks oil prices roughly. All right, oil prices. Look at this. Oil prices bottomed out around June, and then late June and July, and they just started going up. And remember, percentage-wise, it started at $30, and a month and a half later, 2 months later, it's at 36. A $6 move of a $30 stock, that's 20%. Oil prices went 85, 87, 89, 91, 93, 95, 96, 96, 96, and this is starting to go sideways. If oil goes 97, 98, 99, 100, this should go higher. So now you can start to see, hey, let me see this move in the underlying, what oil is doing, and then let me go and see what's going on in the US dollar Canadian as a comparison. So I'm going to go ahead and we're going to move out of this platform just briefly, and we're going to jump back into the Forex charts. So US dollar Canadian was requested. I love that pair. I posted on it in my daily market commentary about 5 or 6 different times, which my daily market commentary gets relayed from my personal website over the FX Street site so that you can see that every single day. All right, so you should be seeing a chart of the United States dollar, Canadian dollar. Remember what we said. We saw that oil prices, equity prices in the oil ETF in that sector bottomed out around July and started to head back up. If that's the case, and if there's a relationship between the United States dollar and oil prices when we look at the Canadian dollar, we should see that if oil prices are going higher, the US dollar should be going down. So as of around July at 1.03, 1.01, 1.0 parity, 99, 98. All right, so about 5 pennies, 500 pips down. Now oil prices are going sideways a little bit. They're a little bit overbought at $96. Equity prices have hit resistance. The United States dollar has strengthened, not a lot, just a little bit, but using that to say, hey, we're getting closer to support. There's a lot of support down here. I believe the $85 to $96 move in oil prices is too big. I'm looking at USO as an ETF. I'm paying attention to that. And I might be getting interested in buying it down here. Maybe I actually had bids in down here that never got filled because I was being a little bit more picky. But this is not chump change. This is a 98.55 to 99. That's about 100 pips right there. That's not bad for a scalper, a swing trader, an intermediate trader, a position trader. If we're managing it, it made sense maybe to start to buy it here, okay? But again, I was looking at old support, and there was a lot of support down here right around 98.60. I kind of put it in. I was being a little picky down around 98 even, and I got really, really close. It came down to 98.37, and that's where I'm talking about, you guys, a longer-term opportunity. I don't trade short-term. Leave the trade open and go walk away and close my computer and hope that everything works out and only risk 15 pips because 15 pips we know can happen in a heartbeat, especially if I'm sleeping and leaving that on for 6 or 7 hours. But given the rise in oil prices, given the decline in the United States dollar versus the Canadian dollar, I'd be willing to buy the U.S. dollar down here, put my stop 60 or 70 or 80 pips below support, and if it rallies 50 pips, 80 pips, 100 pips, 150 pips, that's exactly what it's meant to do. That I'm comfortable with sleeping overnight because if the United States dollar breaks down and goes lower and I have a loser and it breaks support, that's probably because equity prices ran up through resistance, dragged oil prices with them, and the portfolio over here is worth more value on paper. So that's kind of a hedge. That's a longer-term trade. So, yeah, risking 50 pips, 80 pips, 100 pips, that I can kind of walk away with and check once every hour or two. But I would never, ever do that with a short-term trade where I'm only risking 10 to make 15 or 12 to make 20 or whatever the risk reward is. That's got to be managed, very, very close. All right. So big difference in kind of the management styles as far as how much you're checking in on a short-term trade versus a long-term trade. Keep in mind the longer-term traders, you have to be willing to risk 50 pips, 100 pips, 200 pips, 300 pips. Go ahead and do that in a standard account, or go ahead and do that in a mini account. And we know that roughly against the United States dollar, 1 pip is equal to $1. So one contract risking 100 pips is $100. Can you, with your account size, handle a $100 loss? No problem, and have it only be 1 or 2 or 3% of your account. So most people who are trading longer term or doing these hedging strategies either have larger equity portfolios that this is a smaller subset of in foreign currency, or they have larger accounts in other places or a very large foreign currency account that risking 100, 200, 300 pips, they don't bat an eyelash at. Most people who have a $2,000 account, $5,000 account, $8,000 account, they're probably going to be your short-term scalper day trader. You don't have the luxury of risking hundreds of pips when you're doing that, unless you're maybe trading micros, and then you're getting into very, very small amounts, and you're not trading frequently, and that might not keep up with your goals as a trader. So that's a look at the U.S. Canadian. Again, here's my analysis on it for that person that asked. If equity markets are going to get good news out of the central bank all over the world, that are meeting pretty soon, and good economic data, and equity prices bust through 1425 in the S&P and go 1450, 1490, I think that oil prices will get dragged up with it. That's probably as a result of the U.S. doing something to our interest rates, and I think that then oil prices go higher. The United States dollar against the Canadian dollar, because the Canadian dollar exports lots of oil. That's a big part of their currency and obviously a huge commodity for them. I believe that will get stronger against the U.S. dollar. So when I'm saying I'm looking at getting long here, I'm not expecting oil prices to drop precipitously. I'm not expecting the U.S. Canadian to go 98, 99, $1, $1, $1, $2, $3. If oil prices go 96, 95, 94, and the U.S. dollar Canadian goes 98, 99, 50, 99, 99, 50, something like that, hey, hallelujah. I risked 75 pips to make 100 pips. Very, very good trade. Set it up, had risk management, had stops, had targets, used a couple different fundamental pieces of news, used the technical news, and that's it. Nothing fancy, you guys. Just trend, just support, just resistance, and just a really, really good fundamental story. All right? Keep it super simple. That's something that I really, really do believe. So let's see if I can go back here, and I'll just pause this and answer some questions to get you back into these slides again. All right, so you should be looking at my PowerPoint slide. Do commodity pairs and currency have some special trading pattern? I don't know about a special trading pattern, but I think there are some intermarket relationships, as I said, as you see right here on the slide. I think that there are some relationships. They're not always in play, but I think there are some relationships. Keep in mind, you guys, a really rough relationship, and this could change tomorrow with fundamental data and central bank intervention. A rough relationship has been when the United States, when the equity markets around the world decay and decline and go down, the U.S. dollar seems to strengthen. All right, that's a rough relationship. But again, I'm not saying that it is going to happen every day or it's going to continue. Everything could change tomorrow. We constantly have to update our analysis on a daily basis. Do you demo trade as a demo account? I don't demo trade anymore. I mean, I don't think I've ever demo traded. I was a ski bum. I met a trader. I started trading one lots in futures markets and just built up and up and up. So the only time I might trade a demo account is if I'm learning a new market or a new strategy or something like that, but very rarely to go into demo. And that's where I push you guys. If you guys are committed to this, some demo traders become demo traders for a long time. I don't want you guys to do that. I want you to commit and have real emotion in real money, the proper amount of money, but real money, real emotion at stake. All right. So just keep that in mind, that I think getting live and getting in the game and treating it as a business is very, very, that's the best thing to do. So your chance. All right. Again, I work with individuals. I help businesses hedge their cost of goods if they're dealing with interest rate risk and if they're dealing with commodity risk and things like that. So my website is there, JupiterPeakFinancial.com. The same market commentary I put on there, a lot of it filters over to my FX Street profile. I do what's called an engagement interview, your chance to get grounded, your chance to find out what is realistic account risk and trade frequency given the markets right now, your trading time horizon and management, and taking advantage of these relationships given you and your individual situation. It's free. It's no obligation. It can be done over mobile phone. It can be done over Skype. It takes about 30 minutes. I ask you questions. I give you my unbiased opinion, straight summary. I put it into a nice document and I send it off to you. If I never hear from you again, fine. Good luck. Please use my webinars. Please use my market commentary. Please take advantage of that. If you're interested in saying, hey, this might be right for me, I'm going to get some extra information about that, then we talk about that on a one-on-one level. I do shoot straight. If you have unrealistic goals, I'll tell you that. I don't have any reason to lie to you. I do give you my real opinion of, I think, what's achievable. So let me just see what other questions are going to come across before I give you my last site here. What other daily webinars do you host? I'm going to show you that right now. Your analysis is logical and realistic. Thank you. I mean, I know there's a lot of good contributors. I've been doing this for a long time. I love it. I think that you guys all can take advantage of the markets, but I think that you guys have to be realistic about it. And that's why failure happens, because people approach these markets like a lottery ticket, with unrealistic expectations. Quickly, Canada being the biggest oil exporter, U.S. oil and Canadian are highly correlated. No need for special patterns or indicators. So that's Andy's opinion. He's saying there's no need for special patterns or indicators. Use those rough, larger relationships as far as oil and the U.S. dollar and the correlation. One last slide here to review. You learned about me and what Jupiter Peak Financial does. You learned that I think your trading personality is important and you need to hone in on that. We talked about my opinions of fundamental analysis and using that to be realistic in your trading plans using volatility and ranges, and keeping it simple using technical analysis, trend, support, and resistance, and build technically based trading plans. Again, if a ski bum can do it, anybody can do it, but it takes time, it takes discipline, focus, hard work, and give yourself the chance to learn experience. Don't blow out your account by being unrealistic before you get to learn that experience. So use your trading personality to be realistic. Resources, use my FX Street profile. I already have that link that I showed you, and obviously you can search for it very easily. Regular market commentary almost every day. I already posted an article with charts in Forex and equity markets today. That shows up at FX Street and on my website at Jupiter Peak Financial. Lots of other webinars and analysis and commentary at Jupiter Peak Financial. Recordings, I've done about 25 different recordings for various brokers out there. They are on my YouTube site. There's a link to that as well on my Jupiter Peak Financial site, but that's it right there. And again, take advantage of the engagement interviews if you're interested, if you think it will help. Someone's asking, is option trading riskier than Forex trading? All trading is risky if you don't know what you're doing, right? If you approach it, if it's not a business to you. Treat it as a business. You're in competition against me and other great contributors and other great traders around the world that want someone to come in, make a bad decision, and they want to be on the other side of that trade. So option trading is fantastic, but I don't know if it fits you. So again, that's where the trading personality engagement interview is. It might be perfect for you. It might be better than Forex. It might not work as well as Forex for you, but that's where obviously understanding a little bit more about your situation comes in, and that's what I'm happy to help you with. So Options can be very risky because there's just different contingencies on what options can do. But if you use them the right way, they can be great tools. Obviously, Forex is leveraged a little bit more. So it goes securities, like equities, no leverage. Then you have options, somewhat leveraged. Then you have Forex, which is leveraged even more. And then you have futures. So I don't really go into futures much because that's kind of for professional day traders only. And that's for a total living and using that each and every day and keeping an eye on it. But most people don't even have a need for it, and you don't want to go there. So the question from Mike, do you have full-time trading clients who scalp FX, volatile pairs at small time frames? Absolutely. Like I said, it's all across the gamut. If you have more questions on what I do, that's where you can reach out to me via email. So I think it's about time. Thank you guys very, very much for your attention today, for listening in. I know it's at different times around the world. I really do appreciate it. A special shout out to Maud and Vicky for helping me to set this up over at FX Street. They are great. Continue to use the resources here, you guys. Use the FX Street site and combine it with who you are as an individual. Have a very, very good day, afternoon, evening, depending on where you are. This was recorded. You will be able to go back and review this. Happy trading and invest intelligently.